Well, it gives me great pleasure to bring on board Neelkanth Mishra of Credit Suisse to talk about macro, the India positioning, how we should understand risk in this kind of an world, and what he really makes of the India economic recovery, both in terms of trajectory and also in terms of pricing. Neelkanth, good morning. Thank you for joining us. So good to have you back on ET now.
Pleasure to be here. Thank you for inviting me.
The broad smile on your face and my face pretty much captures the kind of India tailwind we are enjoying right now. India has emerged as not only the top of the pedestal market but also as an economy, and given what is happening in the world, I guess we are envy of the world.
So, absolutely. And I think that the current economic growth momentum is actually far stronger than what we have from consensus right now. If you see September quarter GDP growth projections in constant price terms, that is real GDP terms, the 3-year CAGR that consensus is forecasting and MPC is forecasting is 2%. If you see any of the volume indicators, the growth trajectory appears to be far, far stronger than that. Just to give you perspective, consumption of dense energy, right? So if you take coal and oil and gas and renewables, etc., the total energy demand growth in the September quarter was 7% 3-year CAGR. And remember that energy demand grows slower than GDP because energy efficiency improves every year. Now, there could be some base effects. If you remember, there was some coal shortage in September 19. But even after adjusting for that, I think the underlying economic growth is extremely strong. So we are going to slow from here, like the rest of the world. So we are going to see headwinds from slower exports with a lag of maybe 6-9 months. Even services exports will slow down. We have also raised interest rates in India, and there's of course higher interest rates globally. So all of that will mean that our economic growth slows, but it's actually slowing from a much higher level than is currently expected. And the sustained growth rate is going to be much stronger than what consensus is currently modeling.
Why do you think it is sustaining, and will it sustain? Because at some point in time high interest rates will start having impact on affordability. If globally interest rates they go down, it will start having impact in the way how financial investors would be looking at investing in Indian equities.
Yeah, see the point at which actual real world interest rates start to fall could be some time away. So you remember that markets can move very quickly, right? So it's as simple as changing some assumptions on Excel sheets. But remember that the real world is is much slower moving, and a lot of the pain from what higher interest rates do to the rest of the world is yet to be seen. There are real estate markets across the world which are going to be under stress with the higher level of rates. And to see through this point, see the issue with economics, or actually the one very interesting characteristic of economics is that most forces are self-adjusting. If you have higher inflation, you raise rates, you slow down the economy, inflation is expected to come down. If you have excess supply, like say DRAM or panels, almost everyone I know among the younger folks I talk to seems to have bought a 50-inch TV during Diwali because the prices have come down so much, so demand goes up. Now these are self-adjusting forces, so it is reasonable to expect that say 9 to 12 months from now, the economic distortions that we are seeing would have started to settle. But I think it would be a bit unwise to prematurely play in the markets for that outcome, because it's like you're in this on this hill, you're going to be on this hill, but there is a valley in between, and you don't know what happens when you cross that valley, and the risk of accidents in the global economy remains quite elevated. So I would remain very cautious.
You've done a lot of work explaining that how should one read into India valuations, and I'm taking the clock back for the benefit of our viewers. It was in September when house view of Credit Suisse was that, well, you can look at India based on historical benchmarks and call it expensive, but that's not the only way to look at India. What is your view on for those who are of the view that India is a great market to invest in, but it is like buying silver at the price of gold?
Uh, so if you think about market levels into three parts, right? So there is earnings, so 12-month forward earnings. There is global price to earnings, and there is uh, India's price to earnings premium, right? So I'm dividing India's PE into global PE and India's PE premium. Now, on the earnings side, as we discussed earlier, uh, the outlook for earnings is actually reasonably robust. So I think that the 12-month forward earnings will keep improving from here. The the Indian price to earnings premium, which to the world is currently at 51% or so, is something that is unlikely to expand from here. In all of history, it has it has been higher than this level only for 2% of the time. So it is unwise to bet on this premium expanding. It can expand for a short while, but it would be unwise to expect that to happen. Then we come to the global price to earnings. Global price to earnings, given that there is now expectation that perhaps the 10-year bond yields in the US may have peaked, and therefore the risk-free rate is likely to be coming down from here. But remember that in the decade before COVID, the average 10-year US bond yield was 2.2, 2.3%. Even after this fall from above 4%, it's likely to settle well above the rates that the markets were used to in the previous decade. On top of that, you have to add the equity risk premium, right? So when you look at price to earnings, they're the reverse of effectively the cost of equity. Cost of equity is a risk-free rate plus the equity risk premium. That is the excess return that you expect or you would want from the equity markets. The equity risk premium is also currently quite low, given that global growth rates over the next decade are unlikely to be as robust as what was there in the previous decade, and the geopolitical tensions and risks, which are now very obviously visible to everyone, I think that the equity risk premium also may rise from here. So if you have higher risk-free rates globally and a higher equity risk premium, global price to earnings multiples are unlikely to be as high as what we have been used to in the decade before COVID. So the likelihood of the P multiple premium expansion and the P multiples being meaningfully higher is actually, I think, quite low. So what we are relying on is earnings growth because the confidence of India's economy is much stronger. Now, in our view, the 15-month long time correction that we've already seen, and we have been expecting that, we wrote about this in September last year, can run for another 9 to 12 months. And I would stay cautious on the risk of global accidents. But once we have seen another year of time correction, then the earnings growth can start to push up the market from where we are.
Like to draw your attention to the numbers which we've got from banks. The average credit growth from large banks, SBI, ICICI Bank, and even HDFC Bank is 20% plus. Now, just for the benefit of our viewers, if I bring this point out that banks are in the business of lending, and you borrow only when you are confident either of servicing the loan or you're confident that with the borrowed money you will get more returns. So what does that indicate? This kind of credit growth, is this an indication of animal spirits at the corporate level and spending comfort at retail level?
Totally. So the credit growth in by itself is and you I think very rightly pointed out that it not only does it reflect the fact that uh, that growth is robust and that there is more credit available, growth can be stronger. It also shows that that banks are seeing a much stronger economy and therefore they are willing to lend, right? So their risk appetite is improving, and it's also dependent on what they are seeing on the ground. So it's a good read on the economy as well, and I totally agree that that the underlying economy is very strong. I did mention that earlier, much stronger than what people expect. Um, the one note of caution I would throw in over interpreting the bank numbers is that remember that when you see uh, this kind of a dollar shortage, right? So the dollar has now started to weaken finally, but when the interest rates are still high in dollar terms, and anyone who has borrowed in dollars is effectively short the dollar. Now, they didn't borrow in dollars because they wanted to short the dollar, but now that you borrowed, you're short the dollar. So if the time comes for a rollover and the first option of repaying your dollar debt, you're likely to do that. And this is happening by individuals, corporations all over the world, not just in India. So when we look at aggregate growth, we need to look beyond the just the banking system growth and also look at what's happening to external commercial borrowings, how much there are many corporations in India, many financial and non-financial corporations for whom the dollar cost of debt now is comparable to the rupee cost of debt, and so it makes sense to sort of repay that, not roll it over. Now, this is pressuring our balance of payments. So you may have seen our reserves, once adjusted for forwards and all the banking capital flows, have actually fallen much faster than had been expected. So there is very likely uh, a replacement of external debt with banking debt as well. But on the bigger picture, is this a sign of a strong economy? I agree. Does this give us comfort on forward earnings? Remember that FY22 to 25, nearly half the earnings are going to come from PSU in the BSE 100 are going to come from PSU and private banks and NBFCs. And what gives me good comfort is that even in the September quarter results, after the September quarter results, the bank earnings have actually been revised up. So in this globally slowing environment, that's quite an achievement.
Nilkanth, unlike previous global risk of sharp adjustment, this time around world has been a very stable place. We've seen a sell-off in Bitcoin. We've seen a big sell-off in the global bond market. The estimates are that the sell-off in the bond market is even higher than what we saw, let's say, post 2008. Now, despite such a massive wealth destruction, why is that we don't have any casualty yet? I'm glad we don't have it. I will say touch wood before you answer, but I'm curious.
Yeah, touch wood too. But this does not mean that it will not happen. Remember that some of these developments take time to show up. Now, they can be mortgage market cliffs, like say teaser rates issued 2 years back. I recently met an investor whose financing had been at 1.75% in dollar terms 2 years back. Now it came for rollover, it was at 5.75%. So remember that as these financings get due, there are countries where teaser rates were issued at 1.85%, 1.9% for mortgages, where the loan to value ratio is 85-90%. And they were for 2 years, and now and most people took them on because they thought, how much will it go up, right? So it can be 2.5, 2.7, but now in some of those countries the rates are 5%. Uh, there have been news reports of Eastern European countries where uh, mortgage borrowers took loans in different currencies at much lower rates, and now those their local currencies have depreciated and interest rates have gone up. So as refinancing comes up, that's when things start to break apart. So and therefore it is a bit early for us to breathe a sigh of relief, and remain very cautious because the accidents can still happen. What is very comforting is that most major financial firms are well capitalized, and major breakdown in plumbing, at least so far, is not visible. But remember that real estate and mortgage markets are a very large part of loan books for financial firms, and we need to be very careful when thinking through the outcome over the next 12 months. Now, if we are able to navigate the next 9 to 12 months without a major accident, I think then the upcycle with lower interest rates and cleared up inventory, global good supply chains recovering, some perhaps on the geopolitical side, maybe we can see be a bit more constructive. But for now, I would remain cautious.
So, as we look into the future, next 12 to 18 months, what would be the mood point? Last 6 12 months, it was only and only inflation. Could it be growth? Could it be comeback by China? Could it be a comeback in commodity prices? What would be the mood decider?
So, as you rightly said, there were several drivers of uncertainty in the last 12 months. So we found that the the level of inflation that we could see in the developed world was actually much higher than what had been anticipated. The fact that COVID controls in China lasted much longer, are lasting much longer than had been anticipated. The energy disruptions in Europe were much more than just the gas and the oil, but also issues with drought, issues with the repair or maintenance of nuclear power plants in France. So the energy crisis became much more skewed and adverse. In the next 12 months, I think it's reasonable to assume, and it is now starting to become visible, that China will relax COVID controls. That will hopefully improve the the consumer demand, consumer sentiment. But let me just throw in a bit of caution there. We completed a big report on Asian demographics and recently, and what we found was that as populations age, if their government provided social safety nets are not adequate in terms of the defined benefit contributions or defined benefit payouts being as a percentage of GDP being much lower than per capita GDP, then the individual starts saving a bit early, and perhaps that could be an overhang on Chinese consumption as well. But going forward in the next 12 months, I would look for the real world impact of higher rates. The financial markets can move very quickly, can reprice changes very quickly, but the real world moves at its own pace. So the impact of very high mortgage rates on what it does to real estate markets globally, what it does to the balance sheets of consumers, balance sheets of banks, financial firms. I think all of these are changes that we should look for, because remember that the vulnerabilities get exposed only when growth slows. So the firms that had anticipated low interest rates forever, uh, which of them come under stress will only be known over the next 6 to 9 months. So those would be at this stage the points that I would look for. The slowdown in global growth and what other pain points and vulnerabilities that exposes.
So, Nilkan, what should our viewers do? Our viewers look forward to your comments, and how can they really implement it? Should Indian investor now get cautious because the run up in the Indian stock has been too much in terms of the connect with the world and with the real economy?
We have been advising caution now since August, September of last year, where we have been flagging that the markets will time correct. Short of a major global accident, I don't really expect a very sharp correction downward in the equity markets. It will be a grinding down of forward PE and the overall range of the Nifty or the BSE 100 remaining in a band. That's my current expectation. That's what I would uh, sort of narrate to your viewers as well. But within the market, I think there are opportunities. We still think that financials, though they have done very well and they are consensus at trade as you can expect, but given the improvement in forward earnings, given the lower risk of bad loans emerging in the next 12 months, uh, we remain overweight that sector. We think sectors which are associated with an improvement in construction, of housing and real estate, like cement. I think those sectors still look attractive to us. We are cognizant that the current the theme of China opening up is pushing up commodity stocks. Our own view is that this improvement is going to be short term, and that there would be an opportunity to exit rather than build new positions. We also think that the IT services sector, which has very strong balance sheets, extremely good management, good cash payouts, good treatment of minority shareholders, is still a bit expensive for our comfort. And we would only be looking at entering that sector once management commentary on business outlook starts to become a bit cautious.
So let's spend a minute on IT. The consensus view is that every time there has been a recession in the world, whether it was 2000 or 2008, it has impacted IT outsourcing. But the initial comments which we've got from Indian IT companies are that this time it is different, the cycles are longer, there are no deal cancellations, and what is happening to big tech, which is Alphabet, Microsoft and Amazon, will not translate into reality for Indian IT. Would you take this management outlook with a grain of, with a bag full of salt, or you think there is reality in it?
It's a bit early. Remember that US unemployment at the last print was 3.7%. So the US economy, and our markets have been worried about a potential recession now for several quarters now. But the US economy is still quite strong, right? The retail sales are above trend. The goods, there is a goods demand. The wage growth is still quite robust. You are seeing strong rental price increases. Remember that inflation is still 7.7%, right? So it's extraordinarily high by standards of what the US has seen over the prior 4 decades. So I think the slowdown in the US economy is not very obvious yet, but higher rates and what the Fed's objectives are mean that over the next 6 months, the trajectory will be lower, and that's when some of the stress points start to become visible. Also, remember that the IT services firms are mostly about talent, and the pressure on talent domestically from the software as a service firms, as well as remember that if talent is more easily available in the US, given all the headcount cuts in big tech and the venture capital funded firms, means that there will be a lot more competition from US based firms as well. So the operating environment is going to deteriorate in the next, I would say, 6 to 9 months. And when the management starts to comment and starts to become observant or starts to see this in business flows, is the point at which I think the stocks would have started bottoming out.
The data points which have come in and around Diwali, whether it is car sales, mall footfalls, or the kind of uptick we've seen in QSR and branded sales, it is clearly indicating that India is spending more. But is that because saving rates are going down? And do you see this becoming more like a trend, which is what we've seen with other major economies? As we become a large economy, we may save less and we will spend more, and we should not worry about the consumption wheel slowing down, because as an habit, we are saving less now.
Um, no, I don't think we should attribute what is a 6 9 month phenomenon to a complete change in thinking of the human of Indian households. There are many more, I think, issues that affect that. But on the specific comments on consumption, I think it is important to observe that when you lock down economies, lock down people, the segment that suffers the most is services, right? Goods demand, with exception of say apparel or beauty products, generally does okay, because because you're still consuming that. But when you're consuming services, it's mostly about buying someone's time. And when you're buying someone's time, with the exception of, say, medical services or legal services, where the poor buy the richest time, uh, it is mostly the rich households buying the poor's time. And so when you lock people down, savings accumulate among the rich, and the balance sheet of the poor gets affected, which is partly the reason why you're seeing that discretionary and upper income consumption is doing well, and staples and segments more exposed to lower income households are not doing that well. But that's, in my view, backward looking. As the rich start spending, as they realize they can afford the vacations because of the savings they have, as they realize that they can eat out much more often, they are now, so it's like, water accumulating here, and you need a lot more water here, and then the water starts to flow. So as hotel rates go up, as airline traffic, airline schedules in the December quarter for the first time are above pre-COVID levels. You're finally starting to see a lot of flight delays, which is terrible for travelers, but actually a good sign for the economy. What that necessitates is a lot of low-income jobs coming back into the market. What we are also observing in October, the math says, though it's very hard to get good data very frequently from states, but we noticed that tax collections were robust. The state governments and central government borrowed almost as per schedule, but the cash balance that governments have with RBI fell, which means that state governments are starting to spend. So as construction projects start to come online, a lot of low-income jobs get created. So this is a necessary process of healing of the economy, of the healing of balance sheets of poorer households. And so as this happens, in our view, incrementally, the 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 data points and consumption trends for lower income households will be better than what you see for the upper income households. See, remember that our economy is rebounding from much higher than what consensus thinks. And I have a lot of things to say about the anchoring bias of forecasters, etc. But the gist is that going forward, we prefer staples over discretionary, because we think that the process of healing of the lower income household balance sheets is now well underway.
Okay. Just to wrap it up with one final comment, before we go forward, I'll take the clock back. November 2021, IT was enjoying a boom time. There was no fear of inflation. Everybody was convinced that interest rates will remain low for a long period of time, and financials and cyclicals were underperforming. 2022, financials are back on pedestal. Interest rates are likely to move higher. Recession is perhaps a fear which is back on the table, and IT stocks have taken a back seat. 2023, if you go forward, what could be the setup?
So it could be a tale of two halves. And remember that most of the developments that we have, and I don't want to sound like some of those talking heads which give general gyan, but most of the big developments tend to be break points, right? So COVID was one, the financial crisis was another, and so it's very hard to forecast something that everyone tries to avoid. So if you think about, say, the mortgage market in a country where that interest rate cliff is upcoming in the next 2 to 3 quarters, all regulators will be out with fire extinguishers trying to douse all fires, right? Some of the fires they may not be able to douse, and then there will be contagion effects which affect the rest of the world. So the risk of accidents is something that is very hard to quantify and say that this is the probability, because once the accident happens, then a lot of things change. Right? Suddenly, dollar funding markets freeze. Countries with current account deficits can suffer much more than countries with current account surpluses, and India then becomes a lot more vulnerable. Indian demand will start becoming more vulnerable. So it's very hard to think through a period which could actually be a break in the system. we will recover from that, right? So the world will then come together. We'll start to see some easing. Things will change, but you cannot look through some such development. So if that development has to happen, it will happen in the next maybe 6 to 9 months. If we have crossed those 9 months, then I would be much more positive on the domestic cyclicals, which we still are. And the expectation that the Indian economy is going to do far better than the rest of the world. Remember that even after the rebound that is expected in say retail sales in China post the relaxation of COVID restrictions, that process just started, right? So the expectation is that by second calendar quarter of next year, it will be reasonably open. The real estate cycle, in fact, one of the big findings of our demographic report was that as dependency ratios rise, the real house prices start to correct. And our apprehension is that near-term volatility in real estate stocks and real estate construction aside, the outlook, the 5-7 year outlook for real estate in China is not that strong based on the findings of our report. And what that suggests is that the rest of the world may not see as strong a growth as we had seen in the prior year. So our focus remains mostly on drivers of the Indian economy, and we would continue to expect the domestic cyclicals to outperform. But remember that there's a big caveat. We need to be cautious. In the last several months, we've added what we call the hunker down stocks, right? So the points at which we can seek safety in anticipation of a potential risk of a breakdown or a big accident in the global system.
Well, Neelkanth, really appreciate your time. So glad you could find time to join us. It's a Monday morning and it's a busy day with a lot of internal meetings. But the fact that you accommodated this interview request means a lot to us.
Thank you, Nilkanth. Thank you for inviting me. Pleasure talking.